Equity markets have been a bit weaker, and it's come as a surprise to a lot of investors because we've been so familiar with what has been a very strong and almost uninterrupted bull market subsequent to the sell-off that we saw back in late March, early April, associated with the COVID crisis. I take a different view on this though. I look at the volatility that we're seeing at the moment, and I think it's very, very normal. And I remain of the view that we are likely to see the bull market that we're currently in continue through into calendar 21, so next year. And I think there's a range of reasons for that. What I would say though, and I'll run through those in a moment, but what I would say is that I think the nature of the bull market that we're currently in is likely to evolve and change. And again, that's based and predicated off my experience with history. And we've just seen these markets behave the way that they're behaving right now through many, many cycles previously. Now, the reason that I'm confident about how markets behave into next year is somewhat predicated on the fact that we still have very supportive policies in place, both with central banks and with governments. But also because through those policies, what we're seeing is a recovery coming through in terms of economic outcomes. And I'll just spend some time talking about that. So if you look around the world at the moment, we have got improving economic outcomes being presented to us, both in this part of the world and certainly in very key markets like the US. When I drill into it though, it's quite a bifurcated outcome that we see. And what I mean by that is that you have situations on the positive, such as retail sales have been very strong. You've seen housing construction has been very productive, and the unemployment rate that we are getting reported is getting better at a rate than had been expected. So those are very positive. The reason I talk about a bifurcated outcome though is that alongside that there are still some sectors which are performing quite sluggishly. And so if you look at capital spending, you look at manufacturing, you look at certain sectors which are at the epicentre of the COVID crisis, some of those are still very weak. And my expectation is they will begin to improve from this point on. That bifurcated outcome and experience that we're seeing at an economic level is also being reflected in the equity markets. So what we've seen in the first part of this bull market has been very strong performance coming through in the growth companies. And in most particular sense, it's been the technology businesses which have really led the way. And we've also seen it coming through in those companies which are most sensitive to declining interest rates. As we move into the next cycle of this, in a world where the economic outcomes and profile gets broadened and more supportive across the sectors, we will see a change in terms of leadership within equity markets. And I think what we'll see is that the more traditional value companies will do well, and those companies which are most sensitive to the economic cycle, and we call those the cyclical businesses, are likely to do better also. So the way that we're positioning our portfolios at the moment is to recognise that after the very strong run-up that we've seen in certain sectors, we are looking to reallocate some capital, and I think this will happen across the markets towards those other areas which haven't performed quite as well, the value stocks and the cyclical stocks. And I think that will be the key to success in the next over the next sort of 6 to 12 months.